Two stocks to buy near their 52 weeks low. I really enjoy sharing growth stock ideas with you guys on YouTube. Today I have two stocks that were very popular over the last year or two, but for some reason right now, many investors have forgotten about them. The stocks are going down. They're trading near 52 weeks lows. So I'm going to talk about them, and I love talking about growth stocks. The last one was AST Space Mobile. It's up 40% since I talked about it. I mean, those stocks are moving very quickly, but those two stocks are trading at 52 weeks lows. So I really hope you enjoy it as always. The first one is Lulu, which is Lululemon. Most of you guys know the brand. I don't have to explain it to you. It's down 39% over the last 6 months, almost 40%. It's been a disaster. The chart is terrible. And despite the market being so much higher, the stock keeps on going down. Now, for their last report, they did disappoint a little bit. Revenues was only 7%. This is a company that used to grow 20, 25, 30%. Now they're growing 7%. Comp sales is only 1%. Women's revenues, 7%. And believe it or not, the men's revenues is actually growing faster than the women's revenues at 8%. And it has been so for the last 2 or 3 years. And the company made a very smart move into expanding into the men's divisions. And it has been very successful. Now, in terms of market expansion, United States is still very slow for them. 3%. Most of the growth is coming internationally at 19% revenue growth. But what has really crashed the stock, I mean, it absolutely killed it, was them cutting their full year earnings guidance. And it was because of a dynamic macro environment. The CEO said he's not happy with U.S. growth, and they said U.S. consumers are being cautious and intentional about their buying decisions. And again, we don't have the best economy here in the United States, and many people are not paying up for Lululemon, and they're buying something else that's maybe a little bit cheaper, maybe something online from some kind of website, and it does the job. So Lululemon does have a lot of, you could say, a moat in terms of a name and quality. But the biggest challenge for Lululemon and for most of those apparel stocks, which is the reason why I don't invest in them, is because you could have any trend emerge from nowhere at any time. So if someone goes on TikTok, they go viral for wearing some kind of other pants or other kind of apparel, then maybe that's going to take market share from Lululemon, and it's going to become the next big thing. You never know when that's going to happen. So Lululemon will, of course, always have their loyal customers, but you don't know how those trends emerge. Just like Lulu was born out of a trend, you could have something new that's born out of a trend tomorrow. Like most people right now, they're not as loyal to brands as they were 10 or 20 years ago. And you notice that with LVMH, you notice that with many of those companies, Nike, where many people, they like changing things, and they're very cautious about how much they're paying. We don't have 0% interest rates anymore and stimulus checks. So it's a very different dynamic. And again, you don't know when a new trend is going to emerge. Now, for Lululemon, the revenue growth has been plummeting from 30% all the way down to 7%, and is most likely going negative over the next quarter or two. So this is one of the ugliest setups you could see for a growth company. It's the same thing with comp sales. Their comp sales went from 12% to only 1%, and they're likely going negative very soon. This is the worst things, again, you could see for a growth company. But if I look at the valuation of the stock, the forward PE ratio is trading around 15 times earnings. So a lot of it is priced in the valuation. 15 times earnings is the lowest the company has traded at, I believe, since it went public. It traded as high as 80 times earnings. The average was 37 times earnings. And now you could buy it at 15 times earnings. This is, in my opinion, really cheap for a company with 35, 36% return on invested capital. Very smart management team at Lululemon. They also have very high net income margins, around 16.8%, which is high for an apparel kind of stocks, especially physical retail. 16, 17% is very high margin for a company like Lululemon. So 15 times earnings isn't really expensive for the company at all, in my opinion. Now, the only challenge is that earnings per share growth is not predictable. It's all over the place. Sometimes it's 82%, sometimes it's 19%, and sometimes it's negative. Sometimes it's flat. Next year is expected to grow 6%. So if they do grow 6% next year, and you're paying 15 times earnings for 32% return on invested capital, around 16% net income margin, 15 times earnings is really not expensive for this business model if it doesn't really get worse. But I believe Lululemon is a buy over here if you want to take the risk. But I believe the main challenge is the trend that I told you about, where any day, anytime, a new trend could come along and it becomes the hot new thing, and Lululemon loses its momentum over time. And that would be like the worst case scenario for a company like Lululemon. Now, the second one, which is a very interesting stock, it did the IPO not long ago. Many investors were asking me so many times about it, and I told them avoid the stock, it's a bubble. But I'm personally very interested. And this stock is Cava. Cava is down 20% over the last year. This stock was very hot. It traded, at sky-high valuations at $150 up to like 25 or 30 times sales for what people call the next Chipotle. And Cava, here in the United States, if you're not familiar with them, they have, you could say, like a Middle Eastern or Mediterranean fast food kind of restaurants. And it's really healthier alternatives to other fast food restaurants. And many people love their food. And it's becoming well known, and I'm seeing them pop up all over the place. They have 382 stores, but they're expanding their stores with an ambition to reach 1,000 stores by 2030. So they have a business model, they have the store model, it works, it's tested, it's in many different states. They don't have to invent a new light bulb, they don't have to spend a lot on research and development. They have the model, it works, it's very profitable. All they have to do is take the free cash flow, expand, and make sure they don't really mess up the brand of Cava. And as I said, the store is very profitable. They invest maybe like 2.3, 2.5 million. They get 40% cash on cash return within 2 years, 40% within 2 years. This is very efficient. So it's a very, very profitable store. And they have good margins. They have good growth. The company has been growing. There's a net income margin is around 13%, 13.7%. This is really good for a restaurant or a fast food kind of stock. This is not McDonald's. Again, they don't rent out the real estate, but for their model, 13, 14, 15% net income margin, this is high. It's actually very, very good, considering the company just went profitable like a year or two ago. If you look at the company's growth, it's been re-accelerating from 12%, 29%. Last year it was 32%. And this is what I love about it. They don't have to, again, invent the light bulb or come up with some kind of a new AI. They just have to take the money, build new stores, reinvest it, and do it again and again and again. So it's a scalable, easy to grow kind of business model. And I'm very interested, and I like it very, very much. Now, the main reason why I skipped Cava, and that's the reason why I told many investors, is it was trading at like 15 times sales. 15 times sales was crazy for a company like Cava. Now it's at 6.8 times sales. It's much more reasonable, still a little bit elevated, but it's much, much better than 15, 16 times sales for a restaurant kind of stock that's growing 20, 30% in revenues. To me, that was egregious. And now the sentiment and the story has shifted. And to me, it's looking much, much better. Now, the way I'm valuing Cava is I'm looking at their current revenue. It's $963 million for last year, for 2024. I don't expect them to grow 29, 30% forever. I think they will most likely grow, you could say 20, 25% for the next few years. And by the way, I'm using FinChat to come up with my new charts and everything. So if you want to try it out, you get 2 weeks of free access if you use my link in the description. But for my valuation model, I took $963 million. I could take the $25 off, that's by mistake. I could put in 5 years for the next 5 years and 25% a year. So that's very simple. 25% revenue growth for the next 5 years on $963 million. I'm getting around $2.9 billion in revenues over the next 5 years. Now, I told you guys that net income margin has been around 13.7%. So I'm going to take in this number, and I'm going to take in $2.9 billion, and I'll time it by 13.7% for the net income margin. In total, I'm getting around $397 million in net income 5 years from now. And if I put in a multiple of 25 times earnings on that, I believe 25 times earnings is fair. If the company is growing revenues 20, 25%, I think 25 times earnings is fair. And if I time it by 25 times earnings, I'm getting around a $9.9 billion market cap 5 years from now, the current market cap is still $8.6 billion. So to me, the company remains extremely overvalued. And for me to personally buy Kava, I would buy it at the $50 range. So I put in a price alert in my broker at $50. If it gets to $50 or below, I would be extremely interested in buying Kava for the very long term, for a scalable, easy to scale, just amazing, very profitable store-based business model. But if it doesn't get to $50, I'm most likely going to skip it. So this is, again, just my opinion on Lululemon and Kava, not financial advice. Hope you enjoyed it. Hope you got some ideas. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.